Hi, everybody. Today we'll discuss the circular flow of income model, which is the very first chapter in macroeconomics. In this particular model, we talk about the two parts of the macroeconomy, the firms and the households. So this model helps us understand the flow of money and the flow of resources and goods and services in the economy. Initially, we'll assume a very simplistic model where there is a closed economy. So initially, closed economy will be discussed, which assumes no savings, no investment, no exports or imports. This assumption is made so that we discuss about the circular flow in a stepwise manner. So initially, a simplistic model of a closed economy, and then we upgrade to an open economy with linkages to other parties. So let's try to understand the flow. Let's draw the two participants. The two participants are the households and the firms. Now, among them, they exchange. Let me just make a little space for drawing the markets on top. So these two participants, they interact with each other via two markets. One market is called as the goods market, and the other market is called as the resources market. So let's give them a name. This is goods market. And this is resources market. So what happens in the goods market is that people like us, the individuals who are the households. So let's draw a typical household member. So household is somebody who is an individual, or you can consider a family. And this guy will buy a lot of stuff from the firms. So firms are the separate legal entities which are not individuals, but they are businesses. So what do we buy from the firms? That is something that can be shown by a flow of goods and services like this. And so let's name that particular thing. This is goods being bought. And the household, they buy these goods by paying money for them. So let's draw the money flow. So the money flows from the households to the firms. The money spent by the households is called as consumption expenditure. So this term you can remember, it will be useful in the next discussion. Consumption expenditure or simply household expenditure. Whereas the money received by the firms, we have seen in theory of firms chapter, that it is simply called as firm revenue. The other market is the resources market, where we have the transaction that happens is households, they sell the resources. So the households sell the resources and those resources are bought by the firms. So we can show the flow of resources, land, labor, capital, and entrepreneurship. These are the resources. So what the meaning of this is basically the firms, we treat them as businesses. They are not the persons. They employ the persons or they employ the resources owned by people. So what we say is that the land, the labor, the capital, and the entrepreneurship is actually owned by the households, which is used by the firms via the resources market. And the firms do that by paying money for it. So the money flows in the reverse fashion, where the firms will have to pay the households or the resources that the firms use. So what are the various incomes for the resources? The incomes are, we can make a small note here, that land receives something called as the rent, labor receives something called as wages, capital receives something called as interest, and entrepreneurship receives something like profit. These are the various types of incomes earned by the resources. So maybe on this side, I can paste it. Yeah. Now the money flow to the households is called as the household income or simply income. So let's call it as income. And the money that the firms spend, it is called the firm's cost of production. Something that we've seen already in the theory of firms chapter. Okay, so far so good. This is called a circular flow of income because you can see it's kind of a circular flow. And for a closed economy, you realize that suppose the households, their total earnings, let's take a hypothetical figure. Let's say that the total earnings of all the households in the country is something like 100 million. Now, if somebody earns 100 million, they don't save any money. They don't pay taxes. So let me add one part here, that there is no saving, no investment, no taxes, and no exports. So if people earn money, they don't save any of it, they don't pay any tax on that, and they don't spend money on imports, then all the money that they earn will be spent in the form of expenditure. Do you agree? Right? It's a difficult thing to digest because we always assume that we will not spend everything that we earn. But remember, this is a closed economy assumption. It's a very simplistic assumption where we say that people don't save money, people don't pay taxes. So whatever you earn has to flow out. So whatever people spend, that is 100 million, it will be same as the revenue that the firms make. So even the revenue will be 100 million. And again, because the firms don't save money, the firms don't divert the money to investments, the firms don't pay taxes. So again, the whole revenue of the firms will be spent as cost of production. So even that will look like 100 million. So there is absolutely no headache for the economists because the size of the economy remains constant of at 100 million. 100 million not on a per day basis, on a per week basis or a lifetime basis. It is 100 million on a particular time period, which is usually 1 year. Whatever GDP figures, whatever GNI figures that we read on the internet, they're basically for 1 year. So what the very important learning that we draw from this circular flow for a closed economy is that we say, just a second. Let me change the color of this. Okay. So we say for a closed economy, consumer expenditure is same as let's say consumer income. Household income is same as consumption expenditure is same as firms revenue is same as firms cost of production. It's very easy to see why it is so. So we basically are saying that the flow of money or the size of the economy, hence the size of the economy remains constant for a closed economy. Easy, is it? But of course, we know that the size of the economies don't remain constant. They keep on changing. Economies keep on growing, or rarely they uh, decrease in size. It happens because most economies are not closed economies, they are open economies. So I hope this particular model is clear. So what we're saying, if I have to measure the size of this particular circular flow of income, I can just put a meter either at the income level or at the expenditure level or at the revenue level or at the production level, and I can get the same number. That's one important learning. We'll use that in the next discussion. Okay. Now let's complicate the model a little bit and let's talk about an open economy. So say now, open economy. What's the meaning of open economy? We say that In an open economy, there are savings. So people do save money. That's pretty logical. Investments are there. Taxes, imports, and exports. So all these things do exist. So we're essentially saying that so there are new parties like the government and foreign countries. So we add two participants in this whole scenario. They are the government and the foreign countries. So how does our previous model get modified? Let's redraw the previous model. So what color I had used there? Let me use the same color for consistency. So that was a green color for the households and the firms. And they had a beautiful small little exchange among themselves. Households and firms. So what exchange they had? They had some exchange between them of goods and services. So something flew from households to firm and something flew from firms to households. And similarly, there was some exchange in terms of money. So something flew from households to firms and firms to households. We'll not rename all those things again. We'll focus on something else now. So now what we're saying is, let me just put all of this a little on top so that we get some space. Yeah. So now we add three participants to this model. Participant number one is we say banking and other financial players. Yeah, slightly big title it is, not all about that. Okay. Then you have another player that is called as the government. Yeah. And then you have another player that is called as the foreign countries. Let us resize the government so that we do get some space. So foreign countries. Okay. Now, if you look at the households, they do save money. So something flows from the households to the banking sector in the form of savings. So this is savings that is going out. And the money that is saved by people flows out to the firms, and the firms bring that back in the form of investments. I'll try to understand the mechanism here, okay? Let's go back to our example of the circular flow. Now focus on this particular component that we're talking about, the income component. Okay, let's focus on this component. Now suppose there's a person who earns something like $100. So let's say income of a person is $100. Now we know that everybody saves because they're worried about their future and they want some kind of a plan B in place in case if income stops. So they save money, they put it in fixed deposits, they put it in savings accounts and so on. Multiple options are there. So suppose this person regularly saves money. So this is, let's say, $100 per month. That's only for example's sake. Don't get worried about this person. So $100 per month. Suppose savings is something like 20 per month. If that happens, and assuming again for the sake of simplicity, suppose there is nothing else, no taxes, no imports. In that case, how much will that person spend? It will be 100 minus 20, which is 80, right? So you can see that if people keep on saving money, it will keep on decreasing the flow, the size of the circular flow. Because if 100 million is what they're earning and 20 is getting saved, then what comes out of this will not be 100 million. It will get modified to 100 million minus 20 million, which is 80 million. And that's why savings are termed as a leakage. Leakage is something that reduces the size of the economy. So let's define a term called as leakage. And because a leakage, let's give it a red color. So we say flow of money outside the system, which reduces the size of the economy. So savings is an example of a leakage. Okay, so let's encircle that particular thing so that we know that it's not a part of the diagram. It's just a definition. So household, they save money. What they do, they keep a part of their money with the banks. What do the banks do with that money? The banks will give that money as a loan, as a debenture to firms so that firms can invest that money. Now, what happens when firms invest money? So come back again to the circular flow. Now look at a firm. So let me modify, let's drag this on top. Let's have one more text box for firms. So suppose the revenue of firms is something like $100 per month. Okay. So ideally, if they earn $100, they can't spend more than $100. But if they're able to get a loan, so suppose they get a loan which they invest by buying new set of automobiles or by erecting a new plant or by investing in any other kind of capital, new machinery or new technology and things like that. So they spend additionally something like 50 million or let's say 50 per month on numbers. So what we're saying is they earn $100, they receive 50 loan from the bank, so they're able to spend now something like, so cost of production increases to 100 plus 50, which is 150. They will be able to spend 150. So look at what investment is doing. Investment is acting like an injection. So let's modify this figure. So look at this particular figure. This is 100 million. It remains 100 million, but this will become 100 plus 50. So let me modify this figure. Let's make it something like 100 plus 50, which is 150. So quite correctly, it is called as an injection. Right, so we define a new term called injection. It's a breather for the economy because it increases the size of the economy. So we call it as injection. It's flow of money inside the system, which increases the size of the economy. Bingo. Okay, so let's give it a small square around it to understand that it's not a part of the diagram. It's just a definition. Yeah. So savings come back in the form of investments. So leakage that happens comes back in the form of injections. Now, what will the government do? The government is there to collect taxes from us and then to spend it back. So the households pay taxes. What are the taxes paid by the households? There are different type of taxes like income tax and wealth tax. Income tax, wealth tax, and a host of other taxes depending on the country in which you reside. And the firms also pay taxes to the government in the form of corporate tax or business tax and host of other taxes. Now, both of these taxes, whether they come from households or firms, they are leakages because they will decrease the size of the economy. But it'll come back. It'll come back for sure. It'll come back in the form of injection, in the form of government expenditures. So this will contribute to the flow in the form of government expenditure. Okay. So what do taxes do that, again, going back to the example of the individual, focus on this particular example. Okay. The income is $100 per month. Now assume there is no saving and assume there is a tax now. So suppose there are taxes. Tax worth, let's say 25. So if a person earns $100 and that person has to pay 25 as a tax, of course, this expenditure will reduce to 100 minus this, which is 75. So that's why taxes are very rightfully called as a leakage. The same will be the case with firms, and eventually the size of the economy will keep on reducing. But don't worry, the government, they collect tax, it's a source of revenue for the government, and government is a not-for-profit organization. They're not supposed to make any profit. So all the money that they receive, they will spend back in the economy in the form of public goods, in the form of subsidies, in the form of transfer payments, wages to its own employees, and things like that. So that will act like an injection. Now let's talk about the third guy, which is the foreign countries. What role do they play? So people buy stuff from outside. That's called imports. It will be a leakage. So this is imports. But hold on, don't worry because it will not keep on leaking the economy because there is something on the other side that is called as exports. Right? So readers must have realized by now that imports is a leakage. Why is a leakage? Is because whatever money you earn, if you spend part of that on the imported goods, then the money is flowing out of your economy and going to the other country. That's a leakage. If it keeps on happening, it will reduce the size of your economy. On the other hand, exports is basically your domestic firms selling their goods abroad and the money coming from abroad. So that's an injection happening from the foreign countries. So exports is an injection. So let's increase this leakage and this behaves in a funny way sometimes. Yeah, so let's call it as, for example, savings, taxes, and inputs. Yeah, and let's increase the size of this I also. And let's increase the size of this. So we say, for example, investment, government expenditure, and exports. These are all examples of injections. Okay, now these two are important words, so let's dedicate a complete slide on them. Yeah, so leakages and injections. We say that they always occur in pairs. As what are those pairs? One pair is that savings and investment. Pair two is taxes coming back in the form of government expenditure. And pair three is imports coming back in the form of exports. Amazing. Okay. So an important question. Is it always necessary that the leakage equals the corresponding injection? Yeah, that's a big mystery. So you say it is not necessary that leakages are equal to the corresponding injection. Okay, what's the meaning of this? Let's focus on the simplest one, imports and exports. Is it necessary that the imports expenditure, whatever money people spend on importing from foreign countries, is it always equal to the exports that the country does? The answer is no. We know that many countries have, let's say, current account deficit or trade deficit. Trade deficit means the imports is more than exports. So in that case, leakage is higher than the injection. So it's not necessary that they are equal. So there are three possibilities. So we say that if leakages are greater than injections, then the size of the economy reduces. Yeah. So for example, again, if your imports is more than exports, on a long term, the size of your economy will reduce. If leakages are equal to injections, then the size of economy remains same. And if leakages are less than injections, then the size of the economy increases, right? So if the government spends more than the taxes that they collect, which is a case of fiscal deficit, in that case, the economy will grow in size. Many countries, governments, they actually run fiscal deficits, which means government spends more than what they earn by taking loans and things like that. So in that case, leakages are less than injections and the size of the economy increases. So let's beautify this particular part. Yeah. So that completes the discussion on the circular flow of income model, and we'll meet very soon in the next lecture. Yeah. Thanks a lot.